Have you ever wondered why some people seem to achieve financial security with ease, while others struggle to stay afloat? What if the secret to financial stability isn't about how much you earn, but the choices you make today? In this video, we're going to uncover the top 5 financial choices that can build stability in your life over time. These aren't just about saving more or investing in the stock market. They're smart strategies that can future-proof your finances, protect your wealth, and help you grow it steadily, no matter what life throws at you. Ready to take control of your financial future? Let's dive in. 1. Shift to goal-based and automated investing. Have you ever found it difficult to stay consistent with your investing? It's easy to make sporadic investments, but what if you could have a systematic, goal-based approach that grows your money automatically? This is the first step to financial stability, shifting away from idle savings and moving toward a goal-driven investment strategy. Instead of letting your money sit there, losing value to inflation, it's time to put it to work in high-yield savings accounts or systematic investment plans, SIPs. The best part? Automation ensures you're investing consistently, no matter what the market does. You can automate contributions so that every month, a set amount of money is invested without you having to make a decision. When you automate, there's no decision fatigue. Your savings continue to grow, even during market volatility. Plus, many platforms today allow you to optimize tax-saving instruments like ELSS, PPF, or NPS, ensuring your wealth isn't just growing but also working efficiently with tax benefits. This creates a steady, compounding growth that builds financial strength over time. Automation also helps reduce emotional decision-making, especially during market downturns. When you're not tempted to pull your money out in moments of fear or uncertainty, you're more likely to benefit from long-term gains. Over time, as your investments grow, the compounding effect becomes powerful, accelerating your financial growth and bringing you closer to your financial goals. 2. Diversify with tangible and cash-flowing assets. Are you relying solely on stocks and bonds for your wealth? While traditional investments are important, building long-term financial stability requires you to look beyond them. Diversifying into tangible, cash-flowing assets can provide you with multiple streams of income, ensuring that your wealth isn't dependent on one asset class alone. For example, real estate is a great way to create consistent passive income. Whether it's owning direct property, investing in real estate investment trusts, REITs, or fractional ownership models, these tangible assets provide dual returns, both from rental income and property appreciation. Additionally, niche commercial spaces, like salon suite franchises, are becoming recession-resistant, semi-absentee businesses that offer steady rental income. Real estate provides the benefit of appreciation over time, meaning your investment grows in value while also generating regular cash flow. Additionally, tax advantages like depreciation and interest deductions help you increase profitability. As you add more income-generating properties to your portfolio, you create an ever-expanding financial safety net. And it doesn't stop with real estate. Investing in businesses with recurring revenue or dividend-paying stocks can also be a major wealth builder. Prioritize cash-flowing assets that not only provide immediate returns but also appreciate over time. By expanding your asset portfolio, you're securing your financial future, regardless of what happens in the broader economy. 3. Leverage, alternative, and emerging infrastructure. Have you ever thought about investing in infrastructure? But not just any infrastructure? The democratization of private markets means individual investors now have access to opportunities once reserved for the ultra-wealthy. Private credit, AI infrastructure, and tokenized assets are changing the game in 2026. Private credit, lending directly to companies, can offer higher yields than traditional fixed-income investments, and with interest rates in flux, this is a perfect time to capitalize on these opportunities. By investing in direct lending, you can enjoy higher returns while providing capital to businesses in need of growth. Similarly, AI infrastructure like data centers and renewable energy projects are expected to see significant growth. As AI continues to disrupt industries, investing in AI-powered businesses or data storage solutions ensures that you're part of a growing sector with enormous long-term potential. These investments align perfectly with technology-driven economic growth and offer tangible returns from the boom in AI and renewable energy. Tokenized assets, using blockchain technology, are also shaking up the investment landscape. Imagine having 24/7 access to money market funds or treasuries, liquid assets that can offer superior returns compared to traditional savings methods. By investing in these emerging technologies and infrastructures, you're ensuring your wealth continues to grow, giving you access to superior liquidity and better returns. 4. Build a stratified emergency and liquidity fund. What would happen if the unexpected struck today? Whether it's a medical emergency, a job loss, or an urgent home repair, life often throws curveballs. Having an emergency fund is one of the oldest pieces of personal finance advice, but in today's unpredictable world, a single savings account might not be enough to truly protect you. To ensure long-term financial stability, it's crucial to build a multi-layered safety net that provides immediate financial support without derailing your bigger goals. Start by maintaining 6 to 12 months of essential expenses in highly liquid, accessible assets like high-yield savings accounts or short-term certificates of deposit, CDs. These accounts give you quick access to cash in times of need, so you're not forced to dip into investments or assets that are meant to grow your wealth. Having cash reserves in these easily accessible accounts ensures that you won't need to sell stocks, real estate, or other long-term assets when you need money urgently. Interest rate locks are another key element of this strategy. When interest rates are high, locking in those rates with short-term CDs or bonds helps you secure the best returns for your emergency savings. This provides additional flexibility, allowing you to take advantage of high rates while ensuring your fund grows even during times of volatility. Interest rate locks are particularly crucial in today's economic climate, where market conditions change rapidly. By locking in high rates now, you protect yourself from future rate drops, ensuring that your emergency fund remains a powerful financial tool that works for you. This proactive approach helps you maintain financial resilience, allowing you to weather any crisis without losing sight of your long-term wealth-building goals. With a stratified emergency fund, you create a financial buffer that lets you face life's uncertainties without derailing your path to financial independence. You stay on track, focused on growth and resilience, no matter the bumps in the road. 5. Adopt a barbell equity approach. How do you navigate a world filled with growing uncertainty, unpredictable markets, and technological upheaval? The solution might just be in adopting a barbell equity approach to your investments. This approach is all about managing risk in a balanced way, ensuring that your portfolio is well positioned to thrive, no matter what the future holds. It involves combining both high-growth investments and defensive assets, creating a resilient and flexible portfolio. On the growth side, the idea is to invest in sectors that are positioned for massive long-term growth. Industries like AI technology, critical minerals, and defense tech are not just emerging trends, they are shaping the future. As technologies like artificial intelligence, 5G, and renewable energy continue to revolutionize the world, companies within these sectors are poised to reap substantial rewards. These growth-oriented investments may come with higher risk, but they also offer high returns as these technologies continue to disrupt industries and create new opportunities. However, it's just as critical to balance your portfolio with defensive assets that offer stability in uncertain times. On the defensive side, allocate funds to investments like high-quality bonds, gold, and healthcare stocks. These assets tend to hold their value or even increase during market corrections, making them excellent hedges against volatility. For instance, gold has long been a safe haven in times of geopolitical instability, while healthcare stocks tend to be more resilient, even during economic downturns. By following this barbell approach, you can effectively balance high risk with safe, stable assets. This strategy allows you to pursue significant returns while maintaining financial security. Whether the global economy experiences growth or volatility, this balanced approach ensures that you are prepared for the ups and downs, allowing your investments to flourish in any market condition. And there you have it, 5 smart financial choices that will help you build long-term stability and resilience. These strategies go beyond traditional savings and investing. They are designed to protect your wealth, help you grow it, and ensure you're prepared for whatever the future holds. If you found these tips helpful, don't forget to like, share, and subscribe for more actionable financial insights. Let me know in the comments which of these strategies you're most excited to implement and why. Thanks for watching, and I'll see you in the next video.